you can see that we kind of came down here and then we pushed up and we broke out, but then we retraced along that line. And if we look at this, what does this tell us? If we extend these lines out, right, it tells us that gold actually could be doing exactly that. We could be ready to break out, but then it could hop along this line coming down before it starts to make its bigger move. According to the metrics that I have, it should be around 13,000. So again, I've talked about maybe us getting to 3,500. I think anything below 3,900 or around 3,900 is an accumulation zone. And we've basically come to that. And you guys know I was bearish when we were north of 5,000. Said, guys, this is going to correct.
Gold price action is flashing compelling chart fractals that signal a massive macro shift. As technical consolidation reaches critical historical support, physical assets are preparing for a powerful multi-year breakout. Gareth Soloway, a veteran technical strategist and market analyst, observes that current chart patterns reflect the parabolic 1980 gold run with astonishing precision. Accelerating national debt levels and relentless money printing are drastically shortening precious metals cycles. In today's landscape, central banks cannot replicate past aggressive interest rate hikes without triggering systemic insolvency. From a broader strategic perspective, this structural reality reinforces physical gold as an essential hedge against currency degradation. Technical metrics indicate that any price levels near or below $3,900 mark an optimal accumulation zone for long-term investors. While short-term shakeouts may tempt impatient traders to sell, chart projections indicate gold will break out toward fresh highs before reaching a monumental peak of $13,000 per ounce between 2029 and 2031. Now, we present the clips from Gareth Soloway's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold, again, has kind of been struggling. We've come down significantly off the highs recently from the high in late January. Currently, gold is down about 28%. Now, the first thing I look at and I say to myself, okay, so we had a pivot high, pivot low, lower high, lower low, lower high, and lower lows here. But it does look like there's some sort of basing going on here, right? We're getting to a level where there's a lot of technical support historically. And so essentially what I want to do here is I want to look at this and I want to say, okay, in this gold chart, how similar is it to one of the past cycles? And so to do that, what we're going to do is we're going to split screen this, right? And we're essentially going to put both golds on both charts. So over here we have gold and over here we have gold as well. And to do that, we're going to flip this over to the weekly. Check that. We're going to go to this one and do the weekly. We'll keep this on the daily, and I'll tell you why. So one thing I've found is that the gold cycles are shortening, and I'm going to be releasing, I'm hoping today, but at least by Friday, this institutional gold report. And in the gold report, I talk about when the next peak on gold will be, at what price it's going to be, which is, again, you guys know I'm a long-term bull, but there's specific reasons. I'm not just arbitrarily a long-term bull. And I reveal every nuance in this gold report. Inclusive is a gold calculator that I created that lets you put in your numbers and project out where gold is likely to be and when that peak, that next peak will happen. But suffice it to say, in the gold report, I've discovered that the cycles are shortening. Now, the cycles are shortening for multiple reasons. A lot of it has to do with the increase, the exponential increase in U.S. debt, the overall fiat currencies being printed much, much quicker than they were in past cycles. But that's why, essentially, we're going to look at the daily chart in current times and compare it to the weekly going back. It'll give us a better view of more apples to apples in terms of timing. All right, so here we have, on this side, we have the daily chart of gold, right? And we have the gold peak and everything that went on. And over here, we're going to go back to the bull market of 1980, right? Essentially the peak in 1980. We got to go way, way back here for that. And we're getting close here. We're getting close. There it is right here. Now, the first thing that we want to look at is essentially mirroring the bull runs. And I find this absolutely, like, legit, guys, this stuff that I show you is the stuff that makes me giddy inside. And it's just so freaking cool. And again, maybe you don't feel the same way about me where this stuff excites you, but it is remarkable. And so let's look at this. So just a few little tidbits. So number one, look at this right here, this little pattern, up, down, like there before the move. And then look over here. What did we have? Up, down, up, like that, just before it began. Is that not wild? Like, that is incredible. Up, down, up here, and then the bull run began. Up, down, up, and the bull run began. All right. And again, to be honest, that's just something cool, right? I mean, it's just like, what the heck? That's amazing. Now, look at this. We have the bull run begins, we go up, and we have a check back. And then we get our parabolic blow off top all the way to the upside. We go up, we check back, and we get our parabolic move all the way to the upside. I mean, again, you couldn't ping this better. It's incredible. Now, what I'm curious about is you can see big drawdown, bounce, drawdown, bounce, drawdown, bounce, etc. Now, what we're looking at here, folks, is that you can actually, so remember the trend lines that I've had in for you guys, right? So let's zoom in here. And I have this trend line, right? We have this trend line here. And essentially we have this trend line going through this. So we're in this wedge pattern, if you will. And you can see that formation. Well, look at this. Back in 1980 at the peak, you take this down and look at what you get. You get that almost identical wedge pattern formation. And we could do it right from here, and it goes down into this range. And again, what's so cool about this too is you can see this little peak. Here it actually touches or kisses the peak, but it's actually not that far away from it either way. But isn't that remarkable? So look, so the pattern formations are generally the same. I mean, there's obviously small variations, which is why we say history doesn't repeat to a T. It generally rhymes, but this is really dang good rhyming, in my humble opinion. Now, what we want to see is, well, what happened here? Because this is intriguing to me. Because essentially, you can see that we kind of came down here, and then we pushed up and we broke out, but then we retraced along that line. And if we look at this, what does this tell us? If we extend these lines out, right, it tells us that gold actually could be doing exactly that. We could be ready to break out, but then it could hop along this line coming down before it starts to make its bigger move, which is what it did here, right? If you move this up and then it kind of hopped along, it actually made a lower low. So it kind of faked people out. Do you see what happened there? You essentially broke out, which is going to get a lot of people bullish on gold. But then it kind of did this like grind down, and then it started to make its move back to the upside. Now, it wasn't just easy going from there, right? You did have a big rally, and then it kind of came back and retested. You could see over time it kind of fell back into that same level. But the point is that this would make a lot of sense for us to come out here, hover here, and come down, and then finally make our bigger bottom in and move up.
A rigorous technical examination reveals striking similarities between gold's present chart geometry and the historic 1980 market peak. The wedge formation visible today highlights how technical fractals repeat over time. However, the macro backdrop has fundamentally changed. Unlike prior economic eras, modern central banks lack the policy space to raise interest rates to double digits due to staggering debt servicing costs. Consequently, monetary inflation acts as a permanent tailwind for hard assets. Looking closely at these dynamics, it becomes evident that short-term price drops are merely noise within a larger structural bull run. Accumulating positions around or below $3,900 aligns with key historical support. The mathematical compression of cycle timelines suggests the next major breakout will happen much faster than consensus expects, establishing a high-conviction environment for patient capital. Now, let's get back to the interview.
So, again, remarkable similarities here, guys, like absolutely remarkable. But you can see what's happening here. I mean, again, maybe we come down here, but at some point we're going to break out, then hover, and then we get our move up, a la this pattern as well. And it's really remarkable, remember, because look, down move, up move, down move, up move, down move, up move, down move, up move, and then we kind of just dribbled down here. But again, it shows us where gold can likely go. Now, in the cycle report, in the institutional cycle report, guys, I'll give you a little upside action. the peak, not when we're going to hit the next all-time high, because I think that will happen a lot sooner, but the peak I have pinpointed between 2029 and 2031. And according to the metrics that I have, it should be around 13,000. So again, I've talked about maybe us getting to 3,500. I think anything below 3,900 or around 3,900 is an accumulation zone. And we've basically come to that. And you guys know I was bearish when we were north of 5,000. Said, guys, this is going to correct. And it's done exactly what that 1980 cycle is. Now, the difference, and one of the keys here from 1980 is you had Volcker. You don't have Volcker anymore. You can't have Volcker. It's literally, and in the research report, I divulge this. You literally, Volcker cannot exist, because if we had someone that raised interest rates to 15 to 20%, the economy would go into a depression of epic proportions. You can't do it with the U.S. debt. You guys know this. You guys, I have some of the smartest watchers out there. And it literally, with the U.S. debt and the interest payments, could you imagine interest rates at 15, 20%? The country would be bankrupt in a year or two. That's how bad it is. So you can't have that, which is another reason why we had this massive distance between 1980 and the 2011 peak. And then we had a shorter distance between the 2011-2026 peak. And it explains why the next peak in gold, the next cycle, is going to be a lot shorter, which if you're a gold bull like me, that's a great thing. Now, it's not a good thing for the country or the world, because it's telling us something about what's going on. I digress. You guys get the picture.
Analyzing underlying chart mechanics provides clarity during periods of elevated market volatility. Following a steep 28% drop off recent highs, gold is forming a resilient technical base along key multi-year support lines. Historical pattern comparisons demonstrate that market cycles are compressing rapidly. Exponential national debt expansion and rapid fiat creation mean macro shifts occur in tighter timeframes than in previous decades. From an independent market standpoint, this technical environment presents a textbook accumulation setup. The repeating wedge pattern suggests that near-term price dips below $3,900 represent strategic buying opportunities rather than trend reversals. Sovereign debt limitations effectively rule out severe monetary tightening, ensuring gold retains its status as the ultimate store of value. As chart fractals complete their consolidation, the long-term upward trajectory points toward a historic cycle top near $13,000 per ounce, projected between 2029 and 2031. Investors who look past short-term noise and focus on macro fundamentals are best positioned to capture this generational move. Understanding these systemic monetary shifts allows market participants to navigate uncertainty with confidence and precision. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.